so that we can start the session with the Chief Economic Advisor. It's a critical session which really, in a sense, wraps up all that we've been trying to understand today about GST, but also look at perhaps where we are headed beyond GST and the overall India growth story. Neeraj?
Yep, most certainly, Vishnu. Well said. And Mr. Nageswaran, thank you so much for gracing the occasion.
You're most welcome.
Let's start with GST because that's a big thing. The last 4 years post-COVID, we had seen this almost undiluted focus of the government towards capex. This year, starting with the tax cuts and now the GST changes, there seems to be a remarkable pivot towards consumption. Was that the need of the hour to boost growth? And is this a temporary phenomenon? Or would you believe this is the first of the many steps that the government might take and that you might believe should be taken for economic growth boost?
I wouldn't characterize this as a pivot away from public investment. I would characterize this as a complement to public investment. At the end of the day, if you want the private sector to invest or take over the baton from the government, you need to create demand conditions which are sustainable. And you should see it as sort of the complement to the public investment that has taken place. So government will continue to invest. I mean, we were in 2018 about 3.8 lakh crores, Union government's investment. And last year's provisional actuals were 10.5 lakh crores. So we have gone up by more than 3x there. And I think it is natural that at this stage, you try to therefore bring up the enabling conditions for private sector also to start investing, and you should see it in that light rather than seeing it as a pivot away from investment.
Got it. Vishnu, maybe I should have started off by asking him what Minister Goyal mentioned, that he must have had very sleepless nights. So are you sleeping well now, by the way?
Oh, I do.
Okay.
In fact, I wanted to ask you about those sleepless nights, which you've denied just now. I do understand that GST was being discussed for more than a year and a half before GST 2.0 was rolled out. And therefore, it's not related to these US tariffs or sanctions against India. But the fact of the matter is that the timing of the announcement came at a time when we faced, these sanctions. Is there relief for certain sectors of our economy, for example, textile exports to the United States, through the announcement of GST 2.0 at this stage?
No, I think, you had before me two important policy makers, and it will be difficult for me to add anything more than what they had told you. I mean, as the Honorable Minister for Commerce and Industry pointed out, that from the time you get up in the morning to by the time you go to sleep, all the items are covered. And therefore, it will naturally provide a huge compensatory demand pull on the domestic side to whatever we may temporarily lose out on the US tariff side. But that apart, I think, yes, there will be, as he pointed out, some sectors which will require some sort of hand-holding before they can find alternative sources of demand. But I think you did the right thing by pointing out that this GST 2.0 was in the making for quite some time. And it happens to be very well timed, given the current circumstances with respect to the US demand. But this was a natural spring cleaning after 7 years or 8 years of GST 1.0, and it couldn't have come at a better time. Definitely, it will create some sort of a compensation for our exporters in the domestic market. Naturally, the quantums, the which products, those things will have to be seen depending on how it shapes up. But definitely, it is a very important shot in the arm in terms of boosting the morale and also adding to the overall positive conditions that have emerged, as the minister pointed out again, in terms of 3 Deepawalis, starting from the income tax, direct income tax cut, and then the GST, and we should remember also the income tax simplification that happened in between. So I think this is definitely a huge boost, not only to domestic demand for consumption, but also for capital investment. So I think this is independent of what we may need to do for the affected sectors in terms of helping them find new markets and handling the short-term cash flow constraints, keeping their employment without necessarily laying off people, etc., those are separate issues. Whether these things will provide an adequate enough compensation that such efforts will not be required is a different issue altogether.
You know, I had a related question, Neeraj. In fact, when the finance minister was here a little while back,
Right.
she said that there was data that needed to come by her ministry to quantify the extent of quote-unquote damages or suffering or hardships which several sectors which are exposed to the US market presently face. And it's only on the basis of that data that you can work through potential temporary solutions. Where are you in that process at this stage?
No, I think there is a lot of work going on. It's difficult to say exactly we are at the midpoint or 3/4 of the distance, etc. It's very difficult to spell this out. Obviously, as I said, there will be cash flow support required in terms of working capital requirements, in terms of temporary forbearance measures, etc., and also some sort of support required to explore alternative markets. But I'm sure those conversations are very actively going on with both with the Ministry of Finance and with the Minister for Commerce and Industry. It will be very difficult to be precise about where we are in that conversation. All I can say is those conversations are active and happening quite.
Cash flow support is what you mentioned.
I said, yeah, working capital requirements.
Working capital,
because
cash
they
flow
will
support,
see,
yeah.
while the top line will be affected for especially very heavily export-oriented companies, they would have fixed obligations in terms of interest payments and principal repayments, etc. So you do require working capital, cash flow management, and also some support to hand-holding in terms of finding newer markets, etc. And so there will be different levels of support. But the good news is we do have a template from what we did 5 years ago during COVID, and more importantly, this one isn't as pervasive as that one was. And you can target your relief at the right enterprises, and you can target it both in terms of the beneficiaries, in terms of the duration, and because this is hopefully, as he said, this will be something that we will sort out reasonably soon and need not be, in perpetuity.
To your mind, would a falling rupee, and everybody looks at the falling rupee and says, oh my God, what's happening? But currently, because exporters will get a benefit out of a rupee which is weaker rather than stronger, is that actually not an undesirable outcome if the rupee stays weak?
Well, I think in the current context, you are right. It is not an undesirable outcome, because normally you would say, well, a weaker rupee also brings in a higher cost of imports. But then you have an extremely benign situation for oil prices and many other industrial commodities reflected in your wholesale price index being in actual deflation. It is negative number. So this is the situation where I think temporarily a weaker rupee can help. But obviously, over the very long term, you know very well that countries like Switzerland, Germany, Japan, between 1960s and 1990s or 2000, grew their exports not on the back of their weaker currencies. Their currencies strengthened actually throughout that period. They grew their exports on the back of competition, innovation, and quality. So I think, yes, temporarily you can rely on it as a crutch, but it can't do the walking for you.
But is that a distinct possibility? I mean, I know the numbers out there are that it's 1% of exports, total exports, etc. But if the exports are getting hit, if indeed FDI or FPI flows are getting hit right now, could there be an impact on the current account deficit numbers versus whatever, and thereby the rupee as well?
No, I think no. I don't think we are looking at such an impact on the current account number as to weaken the rupee. No, I don't think so. I think we are looking at a current account that is still largely benign, not only for this financial year. There will be some 10-20 basis points increase in the current account deficit from 1 to 1.2 or 1.3%. And next year, if the situation persists, and that's a big if, and if there are no alternative markets which compensate, so you have to have so many assumptions made for you to say, then the current account deficit may widen an inch towards 2%. But even then, it's an extremely manageable number. So I don't see the kind of situation where the current account developments would have a very, very strong impact on the Indian rupee.
So this is not a political question. I'm just asking you as an economist, if India were hypothetically to stop Russian oil imports, wouldn't there be what is called an oil shock, which would impact economies around the world?
Well, I suppose, yeah, I mean, this is like a natural fallout, right? I mean, if you are basically creating, stopping the purchase and nobody else is buying that, you're suddenly basically pulling out a huge source of supply from the market. And as a typical economist would answer, everything else being equal, if you are pulling out a huge daily supply, then naturally it would have an impact on oil price. So that is sort of a fairly obvious and natural reaction that would happen in the marketplace. Yes.
So that's precisely why it doesn't make sense for us to do that.
I'm sorry?
That's precisely why it would be unrealistic for India to ever consider such a step.
Hey, it would impact,
not just for political
it would
reasons.
impact us as well. If that supply were not to be available to anyone, to that extent, India will be back in the market along with others looking for, which is exactly what happened to the natural gas prices in 2022. Right? I mean, because Europe stopped buying, and then they started buying natural gas instead of crude oil, and therefore the natural gas prices for Asian buyers shot up in 2022. A similar situation can happen. So you have a precedence in terms of what happened in the natural gas market in 2022.
I want to come back, sir, and talk about what happens. I mean, I think of it like a troika, that there is a fiscal deficit number, which the government has really adhered to. Let's assume that it is staying at 4.4. So therefore, the loss, revenue loss that happens because of GST has to be compensated by something. What is that something? Is
Look,
it
I mean, first of all, you're assuming that there is a GST-related loss, which on static assumptions, yes, there is. But obviously, if you have the so-called Laffer curve effect, where a lower rate creates more consumption, volume growth, that can compensate for it.
Sorry,
and
can I just ask, do you believe so? You study economic and cycles so well. Do you believe that could happen?
It has happened over the years. I mean, for example, we have been reducing income taxes, we have been raising the threshold limits, but you have been seeing growth in direct taxes, right? I mean, if it were not the case, then you wouldn't be seeing them. So we have the proof of the pudding in the data already. So I think it is quite possible that given the magnitude of the cuts that we have got in GST and supplementing earlier what happened with the direct taxes, I think it's quite possible that the hit is relatively mild, if at all, or it could even surprise us positively. But more importantly, I think the Honorable Finance Minister would have also mentioned, and she did mention it in some other interviews as well, we have to also focus on non-tax revenues. And yes, there is room for expenditure management, etc.
Okay.
Assuming that this huge spurt in consumption, which we all expect, really boosts our economy, what is the time period within which we might see a positive impact on our GDP growth?
Well, I mean, the new rates kick in from September 22, so therefore, obviously, you will begin to see the impact from the third quarter GDP numbers. But, you know, it is difficult for you to exactly attribute the incremental GDP to this effect, because then for that you need to have a certain benchmark estimate. So obviously we look at what RBI predicts, because they are the ones who give you the quarter by quarter breakdown, and then anything more than what they have predicted, you can probably then attribute it to the GST effect. But in general, I think we should appreciate the fact that our GDP growth numbers have proven to be resilient. Yeah. And people like us may have to actually rethink our assumptions. To be frank with you, I have been of the impression that 6.5% is our trend growth rate, because even before the tariffs impact happened for India, the expectation was that exports would be a challenge because global growth was slowing down. However, the GDP growth in the first quarter, or for that matter in the previous 3 years, have been extremely good. I think some of the lagged effects of the good things we have been doing in terms of physical infrastructure, digital infrastructure improvement, and the ease of doing business at the margin may have already taken us to a different growth orbit. So in that sense, we need to therefore know what your benchmark is. The benchmark itself may have already gone up. So it's really difficult to estimate, but I do believe that this will definitely at the margin compensate for whatever negative growth impact we may be expecting from the US tariff effect. But to be precisely able to quantify a magnitude there will be a difficult exercise, because I think the GDP, what is the equilibrium GDP growth itself is already moving higher.
So 7.8 was a surprise. Did it surprise you as well? Part one.
It did.
It did. Okay.
Yeah.
Is there a room for a positive surprise for FY26 numbers?
Well,
To your mind?
look, at this stage, my nature is to be somewhat conservative, rather sort of under-promise, over-deliver kind of mindset. I expected something close to 7% in the first quarter, in real GDP terms. But, 7.8 was good. More gratifying to me was the nominal GDP at 8.8, because many people thought it would be closer to 8 rather than 8.8, which is a good thing. Now, FY26, I have a number which is 6.3 to 6.8, and I pointedly said after the GDP numbers came out that I'm not going to revise my number lower, right? The range is wide enough. Now, whether I will be confident enough to state that actually 6.8, the upper end of my range, will be exceeded, I think that I will wait until the end of the third quarter or somewhere into the midpoint of the third quarter, post-Deepavali, post-Navratri sales, etc., to be able to say that we have overcome the US tariff shock, and if anything, the growth risk is on the upside. So at this stage, I would wait for that kind of data clarity to say that.
But I wouldn't push you to this if you don't want to. But would you believe it could be at the upper end of the range? As of now, do you believe it could hit the upper end of the range?
In my range?
In your range.
Are we going to be at the upper end? Well, I don't think I would be, I would feel confident enough to say that yet. I normally wait for some signs of evidence before I revise my numbers. Again, that's my cautious nature. Yeah.
No, but these are trying times.
No, but I'm just so that I understand this somewhat more. What I picked up from what you mentioned is that there is a good possibility that GDP growth might be spurred as a result of GST 2.0 to compensate for the impact that we might have as a result of these sanctions. Now that ranges potentially from 0.5% of GDP all the way up to 1%, according to which estimate you look at. Therefore, at the upper end, if hypothetically we were going to take a 1% hit on our GDP growth potentially as a result of the US tariffs, what you are suggesting is that if things go well, we could actually compensate. It would be higher than that.
So let me amplify this a little more. It's a good question to pose, and your question is making me think on the spot. So for example, in the interaction that Mr. Rahul Kanwal had with the Commerce Minister, he said, he gave some indications of what the Indian exports to the US are, and the product areas that are affected, they are relatively small. All that is absolutely right. But what we are worried about is the second and third round effects on the overall sentiment, what they do to the employees. If they lay them off, then the demand falls, their consumption demand falls, and then it creates a sentiment effect which can hold back people from investing, etc. So those were all the real reasons why it was not so much the absolute number of the exports to the United States, but the second and third round effect in terms of sentiment, uncertainty in general, and therefore investments, capital formation, as you say. Now, that is where this GST cut could come in as an important game changer. Suppose domestic demand picks up well enough to compensate for the loss of US demand, then the second and third round effects which we are worried about may not materialize. And therefore, the impact of the lower US demand will be relatively smaller, as the minister pointed out. Then in that case, it is possible to say that my forecast will be materializing at the upper end of the range.
Okay. I believe, the CEA did put out this recommendation that investments from China should be looked at. Correct me if I'm wrong. Now my question is, in this conclave, we've heard the FM say that she's cautious about it. The FM has said, the finance minister has said that she's cautious about it. The commerce minister has said it's a work in progress. What are the positives versus the cautions that you as an economic advisor think at the current state for China investments?
First of all, I said this about 15 months ago in the last economic survey in July 2024. And the point is, we are engaging in economic relationship with China in the form of higher imports, in the form of imports, which have picked up quite significantly even after 2020, right? So the question is, what is that method or form of engagement with them that minimizes or reduces our strategic vulnerabilities. That was my goal, right? I mean, I know that the relationship is fraught and it has a lot of other dimensions attached to it, and those things have to be kept in mind. I think the Commerce Minister said it very correctly. The job of the advisor is to create these thought balloons, and policymakers have to consider more than the economic dimensions before they sort of give the final answer. But even now, I think those dimensions haven't gone away. I think they are there. But at the same time, it is a balancing act, as with most things. And my objective of putting it out there in the public domain was to think about what is the optimal way of engagement. Is it only through imports, or is it some proportion of the two, which will prepare us in the long term to become more self-reliant? That was the underlying logic. Yeah.
Can I just ask you one final question? And because you're here, and it's just wonderful to have you. We keep talking about a young India and our demographic dividend. It's potentially our biggest boon. But then skeptics of this would say that you can use the benefits of your demographic dividend only if you're generating enough jobs. My question to you is, are we generating enough jobs for India to use this demographic dividend in order for us to become a developed economy, which is our stated purpose?
Yeah, we are generating enough jobs. You see that in multiple indicators, not just the PLF, Periodic Labor Force Survey data. You see it in the EPFO, Net New Joiners data, Provident Fund Organization. You see it in the monthly purchasing managers indices. You see in the Naukri job index. So you see in multiple indicators, we are generating jobs. The question is, are we generating enough jobs that also pay well? But that is not just an employer's problem. I think employees also seem to prefer flexibility these days, rather than the comfort of a fully paid, fully secure, full-time job. They feel that they can sort of do multiple things. So we are creating jobs, but the important thing is this needs to happen for the next 10 to 15 years. Yeah. So it is not that we are not doing it. We are doing it. Otherwise, we will have a much bigger problem. We won't be talking about consumption growth happening, etc. So it is there. The question is, we need to sustain this in the face of what's happening in the world of artificial intelligence, with, and multiple other developments, which makes it imperative for us to generate at least 8 to 10 million jobs a year, or I would rather say 8 to 10 million livelihoods. It could be jobs, it could be nano-entrepreneurship, it could be a combination of the two.
Well, so it's been wonderful speaking to you. We started on GST and we ended up talking about demographic dividend, but it's great to hear your views. It is all linked up. Ultimately, we are talking about the India story. Thank you so much, sir.
You're welcome.
We're privileged to have had you at this conclave. Thank you.